how you know your company is investable? If not, how to transform your company to become investable? And to be attractive to investors, the company simply need to be or to secure the top right quadrant, the highly competitive quadrant. Means the company can capture large market share. SWOT analysis, pastel been used by a lot of companies for even fundraising, but they are not usable. They are mainly for bachelor degree, master degree, or general communication. We are using TMOS revenue model. So the investable quadrant is a unique value position. It's measurement that tell that these are the low-hanging fruits, area needed by customers, and can win the market competition. And the other quadrant we measure is an overserved area where customers don't really care you offer or not because they don't really need it. Action for the company is to stop offering, reduce the cost. Those equals to additional net profit in the near future. And revenue blockade or deal breakers are the areas where the company is losing revenue to competitors. You should spend resources to improve the offering in this area because it will increase the revenue and profit in short term. Underserved area are very interesting. It's not every time you can find it in all companies. You rarely come across it sometime. This is a place that it shows us that market leader is needed. There is opportunity for first mover advantage, opportunity for company to sell at premium, and opportunity for company to be the next unicorn. So this is the TMS revenue model of MyTaxi 2012, known as Grab now, worth more than $40 billion when it was listed December last year. So this is a revenue model of ordinary taxi in Malaysia, year 2011. That time, the customer already demonstrated a strong need or must-have that they want to arrive at the destination timely. They want to access to the taxi services convenient, and the passenger must be safe, and the fee must be predictable or what is a fixed rate. But the reality is that taxi at the time are not competitive. We're not competitive in this area. They are not punctual. You can call, but you may not get a taxi and you wait for half an hour is normal. Get for 1 hour without taxi is quite like acceptable. Safety of passenger, okay, every month you come across news about rob and sometimes even kill. And the fee sometimes can be more, slightly more, is good. But if you see double, then it's kind of like, yep, it happened. Yeah. So this is a TMOS revenue model of year 2012 comparing MyTaxi and ordinary taxi. You can see that all these areas that must have score poorly by the ordinary taxi in KL, MyTaxi or Grab today, they have already scored very well using their mobile app, e-hailing app in year 2012. So MyTaxi have gained a high unique value position versus ordinary taxi at the top right quadrant. And the winner was already known to the investor when MyTaxi was launched in year 2012. So that's why Temasek and the rest came in. And the other case, or the other TMOS revenue model is about the film camera. Let's say you're a film camera company in year 1996. Kodak commanded 2/3 of global market share of camera. And this is TMOS revenue model of year 2000, shown that a film camera, these are the requirement or must-have of their targeted customer or camera user. They want to able to use the camera quickly. Resolution must be able to be high or more precise or more sharp. And they want to do some minor editing like color enhancement or saturation, and they want to see or view the photo immediately. Like, you know, wedding, you shoot some photo, you want to know if it's good enough, or else if you use a film camera, if let's say things are not well, do you want to have another wedding ceremony so that I can take a good photo, right? So, and ease of storage. So, and what should a film camera like Kodak's do or at that time? By the way, the actual digital still camera was first developed by Steven Sezon. He was the engineer of Kodak. And the solution that time they should have actually done or do a TMOS revenue model or something like that, comparing a film camera versus a digital camera. And they'll find that digital camera at that time already have a strong competitive advantage over the area that they have or they were doing poorly. And giving the brand equity, distribution channel, financial power of the incumbent Kodaks, it's very likely the film camera company will continue to command the top right quadrant through diversification, merger, acquisition into digital camera industry. But history tells us they didn't do it well. In year 2000, film camera had more than 85% of the market share. And 9 years later, 2009 and year end, film camera had less than 20% of the market share, and now it's worse. And this another TMOS revenue model. In year 1999, ordinary airlines TMOS revenue model that people want affordable price, but then it's not competitive. People want to arrive at safely and also on time, highly competitive. Comfortable seat, so far so good. It's not as poor as a bus, but it's at least acceptable. In-flight food and beverage, you cannot complain too much while you are flying. And in year 2000, AirAsia was sold to Tony for less than $1. And when AirAsia went after those underserved area, so affordable price, the incumbent not doing well, they offer budget airline. And even sometimes the offering that the price could be as competitive as you take a bus from KL to Penang, which is less than 500 kilometers per hour, and same price. And arrival, no, not really. So they are not that punctual. Sometimes you're late for 3 hours, 6 hours, but then the time people say, who cares? I'm flying. I cannot even afford that previously. Now I'm flying, so I wait for 6 hours. It's okay. And safety, there's no compromise. Comfortable seat, almost like a bus, right? If you've tried that before. And in-flight food and beverages, basically not offering. You have to really pay a very high price for that. And in less than 10 years, AirAsia went from $1 to hitting 3.8 billion US dollar. So it's quite an amazing growth.